Welcome to Inside Economics. I'm Mark Sandy, the chief economist of Moody's Analytics, and I got a slimmed down crew today. That's Mr. DeRees, Dr. DeRees. Good to see you.
Good to see you, Mark.
Yeah, it's just mano a mano again. We're
Yeah.
missing Marisa, the Dante, the whole team. Everyone's gone. It's just us. And this is Saturday morning, which is really unusual. I've been traveling all week, so got back late yesterday and couldn't record the podcast until now. So thanks for doing this.
Absolutely. Where were you? West Coast?
Yeah, we were in Salt Lake for a day and then Southern California for a few days. So yeah, the folks in Salt Lake told me I picked a good day to come. It was only 100 degrees outside. So
Oh, wow.
yeah,
Okay.
it was pretty brutal. I really don't know how you manage through all that, but people do. Southern California was gorgeous. That was
Yeah.
beautiful. Yeah, the weather
Okay.
was always nice there, but it was really, very nice. And you got back from Italy?
I did. I was back earlier this week.
And
Very hot there too. So another
really?
heat wave going. Oh yeah, they're in the hundreds as well.
Really?
Yeah.
Wow.
So,
For Italy, does Italy, I mean, is this unprecedented heat or just hot?
yeah, it usually
Unprecedented.
does. It gets hot in the summer. That's natural. But
Yeah,
this year really,
brutal.
really brutal.
Oh boy. I wonder what that means
Yeah.
for the vineyards. That can't be good. Or I don't know.
Well,
Maybe I have no idea. Do you know?
I don't know. I think it
Yeah.
might be. I think it might be.
Makes it
High quality,
sweeter or
but
something.
smaller,
Yeah.
smaller production, lower production, but higher quality perhaps. But
Yeah.
I think it really depends because they also had a lot of rain earlier this year as well. So, the timing of those weather events is
right. Well, good to have you back. You had a good
Yeah.
vacation. You were there for a couple of weeks, I think, at least
I
2.
was. It was nice.
Yeah. Yeah,
That's
you do look rested. That's great. I'm glad you're back. Well, I thought for this podcast, we kind of take stock of 2023 year to date. We're kind of a little over halfway through and, lots happened. I've already forgotten a lot of what's happened. I mean, it's pretty action packed. Thought we'd take stock of that and maybe also think a little bit about the second half of the year as well. Sound like a good game plan? Does that sound like?
Absolutely. Yeah.
Okay. All right. Well, I think kind of top of mind, first question is that I've been getting is, what about the economy's performance so far this year has surprised you the most? A lot of different things going on. What's been most surprising for you?
Yeah, I would say it's really the resilience of consumers and businesses. Right. You mentioned all the risks, all the things that happened this year. I think we already forgot that there was a debt ceiling drama for a few months and we had the banking mini crisis, right? High rates. And I think I underappreciated just how resilient consumers and consumer balance sheets really were. I knew they were strong. That's why I didn't expect to see a major drop off, but consumers just have been continuing right through, right? Their spending just keeps going, even with high levels of inflation still. They're tapping into their savings, continuing to support the economy through their spending. Businesses also still looking ahead, right? Obviously, they face a number of challenges, but they've also continued with their investments and looking ahead to expand. So I think that's a key source of the strength of the economy so far. If we hadn't had those types of supports, I think the shocks we did experience would have created more ripples in a different environment.
Yeah, I mean, the economy has been resilient. We're going to get the GDP for the second quarter, I think, on this coming Thursday. Is that right? Or Wednesday? Thursday? I can't remember which day.
I think so.
I think it's generally Thursday. In our tracking estimate, we take all the monthly data as it comes in and translate that into what it means for GDP growth in the current quarter. I think we're at 2.2% real GDP growth in Q2. That's on top of 2% in the first quarter. So that means first half of the year, 2% ish.
Yeah.
Which, that's the economy's potential rate of growth. That rate of growth consistent with enough jobs to maintain stable unemployment. Unemployment has been rock solid in the mid threes. So consistent with that. That's pretty good. And you're saying, we were having this conversation at the end of last year, thinking about the first half of this year, you would not have thought 2% growth.
No.
Right.
I thought it was positive still, but certainly weaker.
Right. And of course, the hand in hand with that is the job growth also.
Yeah.
More resilient. But you say, okay, consumers have hung in there. Their spending has been more resilient. Why? I mean, what do you think's going on there? Why has it been more resilient?
Yeah, I give a lot of credit to the balance sheets, right? The excess savings that we point to, or we have pointed to on the podcast. Just that's a significant source of support that you can tap into, or consumers have been willing to tap into, to continue to support their spending. On top of that, you mentioned the job market. Wage growth has been strong, right? That certainly is another source of support, particularly for those households at the lower end, which may have already exhausted most of their savings. At least they have this wage increase coming in that can help to offset some of the financial pressures as well. So again, I see that as really the reason why consumers have continued to be willing to spend.
Yeah. Now, okay. I mean, that feels a little unsatisfying to me, right? Because because we knew about the excess saving, right? We've been tracking the excess saving, and the excess saving, just for the listener, is the extra saving that occurred during the pandemic, above which would have happened if there had been no pandemic. And part of that was lower income households getting government support, although that probably is pretty much gone at this point. The other part of that is all middle income, high income households sheltering in place and not being able to spend during the pandemic, and they saved and have all this cash, that's sitting in their checking accounts, and they've been using it. But we knew that coming into this year that there was a lot of excess saving.
We did, but I think I believe there was a debate. At least I was debating whether that saving was truly available for spending, or if consumers were viewing that as wealth, that maybe they were just parking that cash in an account for now, trying to see how they should deploy it, whether they should buy stocks or bonds, or kind of wait and see, but not that they would actually be using that to continue to support spending in the absence of a crisis, right? If we were truly in recession, sure, that's when people will deplete their savings and do whatever they can to stay afloat. But this was depleting savings just to continue the level of spending, the trajectory that they were already on.
It's funny. I'm not surprised by the folks using cash in their checking account to maintain their spending. That seems like, oh, duh, they're going to do that, right? Especially the American consumer, right? I mean, what's the old adage? Never underestimate the hedonism of the American consumer. Yeah. That's been a pretty good forecast rule forever. What actually surprised me on the spending side was they didn't spend more. I mean, they haven't been spending with abandon. It's not like they're out, dropping their saving rate to a significant degree. They've been amazingly calibrating their spending, right? So if you look at real consumer spending, that's the kind of the whole shooting match. That's everything that people spend their money on, from vehicles and other goods to travel and other services. It's 2%. On the nose, 2% on the nose. And it's been like that for well over a year, maybe a year and a half now. I mean, just, some months a little higher growth, some months a little lower, but about 2%. I find that's what I find so surprising, that it's been so, carefully calibrated. Consumers have been drawing down their excess saving over the past year just to supplement their purchasing power. Their real incomes have been under pressure because of the high inflation, but they've been able to draw down that savings to supplement their purchasing power just enough to maintain the spending and hit that number right on the nose, the 2% real growth. And of course, consumers are the bulk of GDP, thus you get 2% GDP, that kind of thing. No?
Yeah. No, I'd accept that, but there's certainly a lot of shocks still out there, right? So why didn't consumers spend even more? I think there's still a lot of uncertainty, right? So
Right.
that would cause them to calibrate a bit more.
I'll
I
tell
will
you,
tell you that the consumers are definitely spending in Europe. Right. Italy
American
was full of
consumers
Americans,
full of America. Oh, is
more
that
than I've
right?
seen in the past. So
Huh.
clearly there's some segment of Americans out there that's,
When
I
also
think,
a strong
accelerating their
dollar.
spending.
The strong dollar's got to help too, right? I mean, sort of strong. I guess the dollar euro is what, 113, 114, something like that, which is
Yeah.
it's pretty strong dollar.
It's weaker. It's
It's
weakening.
weaker than it was, but
Yeah.
in the
Yeah.
grand scheme of things, that's a pretty strong dollar, I think.
Yeah.
No? Yeah.
Yeah.
But okay. Um, I'll tell you what, the thing that surprised me, and it's not unrelated to the consumer, but a little kind of different perspective is jobs. I've been surprised by how resilient the job market has been and how consistently businesses have been able to generate new jobs that I think average monthly job growth in 2023 year to date has got to be over 300,000, around
I
300,000
think it's
per
right
month.
there. Yeah.
It's right there, which is pretty incredible,
Yeah.
right? Yeah. Pretty, I mean, because, kind of the rule of thumb we've had is, underlying labor force growth, abstracting from the ups and downs and all arounds, is probably not more than 100K per month, right? So, an economy can't sustain them up above 100K for, lengthy periods of time. Can in the current, in 2023, because we had a lot more labor supply too, a lot more working age population and labor force participation picked up. So that's been helpful. But, longer run, we can't support job growth that's over 100K. And here we are, well into this jobs recovery, and we're still creating 300K. And, it goes to, interestingly, it goes to just pretty low layoffs. I mean, layoffs have picked up, this year compared to last, particularly in the tech sector, maybe a little bit in single family housing or mortgage originations and bit manufacturing. But, outside of that, layoffs remain incredibly low. And the dynamics are, it's less clear to me what's driving that. In the case of the consumer, they got cash in the bank. So they, that feels like that's a pretty easy explanation for why they're able to spend. The explanation for why businesses aren't laying off workers and why job growth is so strong, that's a little bit more difficult, don't you think, to explain?
Well, I think the labor force participation was a bit of a surprise, right? Not so much the fact that we are creating all these jobs, but that
You're surprised by a lot of stuff. I wasn't surprised by that. No, come on.
That we keep finding people that are willing to come back in the labor market. That you got to be surprised.
Not
women's labor force participation at an all-time high.
No,
that keeps growing. That we're going to continue to find people.
Yeah. Our labor force, go look at our forecast that we did before the pandemic of what the labor force participation rate would be today. Is exactly where the labor participation rate is today. Nothing, no surprise. No, at least, no. So I would say that hasn't been surprising to me. But why do you think businesses aren't? Well, first of all, do you agree with the characterization that job growth has been strong largely because layoffs have remained low? I mean, hiring is strong, although that feels like that's more normalized more recently. So it feels like it's more on the layoff side that the reason why we can be able to continue to generate such strong job growth. Is that fair characterization?
That sounds right.
Yeah. Okay. And so what's going on? I mean, the kind of the pat explanation is labor hoarding, right? Businesses realize that their number one problem is going to be through thick and thin, through whatever it is that we're experiencing now. On the other side of it, they're still going to be left with a tight labor market. Just demographics, the aging out of the boomer generation, the slower foreign immigration into the country, which is key to labor force. So they know that they're going to have a perennial problem filling positions and retaining workers, and therefore they're just not willing to do that right now. Is that the answer?
I'm a little dissatisfied by that. Right.
Yeah.
I can see it to some extent. Sure. If I know that this slowdown is going to be temporary, right. I'm willing to hang on to some folks that otherwise I might not otherwise have, because I know what the other side of this is going to have. But there's a limit to that. A business can't afford just to, hold a reserve army of workers out there doing nothing, and hoping that the demand comes back later. So that just doesn't sound right to me as that being the major reason. I think I think there is true growth. I think the consumers do remain strong, and they're still seeing a lot of demand for their services and the products. And that's why they continue to hang on to their workers, right?
But productivity growth has weakened, right? I mean, we're consistent with the idea that there's labor hoarding, that, demand, it's still growing, but it's growing more slowly than the growth in labor input, the job growth. And so productivity growth, I mean, you saw this big pop in productivity growth coming out of the pandemic, like you typically do coming out of a recession. But since then, it's been flatlined, it hasn't gone anywhere. So that is consistent with the idea that businesses are saying, okay, I'm willing to live with less productivity growth, which means weaker profit margins, which means lower profitability, at least for a while. That's consistent with that.
Yeah, I still see a productivity as undergoing through a transformation here, though. I think we're still dealing with the remote work, hybrid work, optimizing around that. So in the interim, in the short term, you can have productivity growth being low. You're investing, if you will, for a future where productivity growth will pick up. And AI might be the next factor or example for that, where in the short term, you actually may see productivity go down as you're trying to figure out how to use these new tools and technologies. You actually, you're running the old process in parallel with the new process that's actually reducing your productivity. But then longer term things will turn around. And I still see firms struggling with the whole remote work, hybrid work environment. So I see that as being another structural factor on top that may explain some of that weaker productivity growth. So, I don't see that as hoarding, though. I see that as transformational, right?
Right. Yeah, and you said something that kind of resonates with me that hadn't dawned on me until recently. If I'm a business person and I hear the words recession, but then I hear in the same breath, oh, it's going to be a short, mild recession. Maybe a few months, maybe 6 months, maybe down a little bit. I go, oh, okay. And I've been now through many years of fighting to find people to work for me. Because this goes back to way before the pandemic, right? This labor shortage, business's number one problem being labor, is not new. It's been around for a while, almost a decade now. Well, not quite a decade, but kind of in that ballpark. And you're saying, oh, okay, if it's going to be short and mild, I'm not going to lay on anybody off. Maybe on the margin, on the fringes, use this as an opportunity to, maybe restructure a little bit, but I'm not going to lay off in a big way. Yeah. Sound right? That's what you're saying.
I just won't hire, right? Yeah. I'm gonna reduce my hiring at that point.
Yeah. Right. I reduce hiring, but not lay off workers.
Right.
Yeah. No, that makes sense. Okay. I think here's the other thing though, I'd point out with regard to this surprise, particularly around the job market, is maybe we'll find out that there wasn't as many jobs created, and it wasn't the surprise. There were really, it's just, we're surprised because it never happened.
It's wrong.
It's wrong, right?
Yeah.
And this goes to the revisions, right? Because the job market data that we look at, the monthly data, the payroll survey data, the data based on a survey of businesses, that's a survey, so I don't know how it's 250,000 establishments, something like that, so it's big, but it's still a survey. This data gets so-called benchmarked to actual employment estimates based on unemployment insurance records once a year by the Bureau of Labor Statistics. And sometimes those revisions are big, and we could see, pretty, and I wouldn't be surprised at all if we saw some substantive downward revision in the estimated job growth that we've seen so far this year.
Yeah. I mean, 300,000 a month is just an incredible pace, even in any environment, right?
Right. That's the one thing I've learned over 35 years as a professional economist. When something doesn't quite add up, it really doesn't. It doesn't add up. It doesn't add up. And the data ultimately is revised. Even the GDP number, I bet you the GDP, certainly last year when you saw those 2 quarters of negative numbers in the first half of 2022, which if we had done this podcast a year ago, that would have been the surprise. Where did those negative numbers come from? I'm I'm still betting that once all those revisions on GDP come in, and they're a lot more coming, that gets revised away. And it wasn't strong. I'm not saying you had strong growth, but I'm not. I bet you we didn't experience 2 quarters of negative GDP. Just my intuition.
And right now, GDI, gross domestic income, is pointing to weakness, right?
That's pointing to weakness.
So
yeah,
it could
right.
be that the strength you're seeing right now may not be quite as strong.
Yeah, right. Because GDI, gross domestic income, was stronger in the first half of 2022. The flip of what's happening right now. Right. So yeah, you take the average of those two things. That's probably reality. Right. It's basically saying slow growth, 1% kind of growth, GDP growth, which is more consistent with kind of what we're observing out there. So,
and our original forecast.
In our original forecast. Yeah, exactly. How in terms of surprises, let me throw one more out. I got a couple other surprises. Do you have more surprises as well?
I got plenty of surprises.
Oh, you got plenty of surprises. Let me throw one out that I know is your favorite: house prices.
Oh, that's where I was going to go.
Oh, is that where you're going to go? Okay, go.
Yeah.
So go there.
So I guess I wasn't terribly surprised by the slowdown, right? We had been calling for a slowdown in prices throughout last year. We actually got some heat, right? We were kind of on the low end of consensus at the time. So when house prices actually did slow down, I actually even turned negative on a year over year. I wasn't terribly surprised by that. But more recently, we see house prices holding up much better. And I think where perhaps missed was just how strong the lock-in effect is. And the fact that you have very limited inventory of homes for sale, people hanging onto their homes because they've locked in these very low mortgage rates. And that has overwhelmed the affordability issues given the higher interest rate. You would have thought demand would pull back, and has, but that's that lack of supply that has really kept prices from falling much at all. In fact, they're starting to rise again in many markets.
Yeah. So the idea is that most homeowners with mortgages. Here I'm gonna play a little statistics game with you right now.
All
okay.
Right. All right.
I want to see how good you really are. Really good.
There's no Marisa here.
Yeah, here you go. How many single family homeowners are out there, do you think, roughly speaking?
Oh.
Roughly speaking, because I don't know the exact answer either, because I didn't think I was going to ask you this question before I asked it.
Right. I think through it's been a while. So 100, what do we have?
Well, the home ownership rate is,
we know about 120, 130 million households.
Right.
Home ownership rate is about 2/3.
It's on the nose, actually.
Yeah.
66%. Yeah.
Well, that another data point you should take with a grain of salt.
Oh, true. Very
but
true.
Yeah, it's 2/3 on the nose. So
yeah, do the arithmetic. So what is that? 75, 80 million people?
Yeah, something like that. Yeah.
Okay. And how many of them have mortgages? How many people have mortgage?
Oh, about half.
I thought it was a little more than, yeah, it's a little more.
Oh,
about almost 50 million have mortgages.
Okay.
Yeah. You don't believe me. You're doubtful.
No,
I see it on your face.
I have an old number, right? So
yeah.
I haven't looked at it recently.
We know exactly, because we get the data from Equifax, all the credit files in the country every month. So we know exactly. So we can go take a look. I think it's like 49.3 million. I'm just maybe we'll look that up before.
Are you subtracting out the second mortgages there?
That's just first mortgage. First mortgage.
Well, but it's a first mortgage, but you could have.
Well, as defined by the bureaus, right? First mortgage, right? I mean,
I guess first mortgage on the property, but the owner might have.
Oh, you're just trying to squirrel out of you. You didn't know the answer.
I think it's 50%.
I think second mortgage.
I think it's closer.
No, I don't. Okay, maybe you're right.
Sandy overcounting going.
Yeah, maybe you're right. Anyway, where was I going with that? Oh, this is it. So you got, say, let's just round to 50 million. 50 million people. The average coupon, the average interest rate on their mortgage, because of all the refinancing that's been done over the years, and the fact that mortgage rates got so low. I mean, if you go back before the Fed started raising rates in 2021, I think we got down to what, 2.5%, 2.75% on a 30-year fixed. I mean, something like outrageous number.
Ridiculous.
By the way, have you noticed when you ask people about their mortgage rate? Everybody's got that 2.5% mortgage.
Yeah.
Oh yeah, I got 2.53. You know, everyone's a genius. Got a more. It's like so shocking to me. Like everyone's got that lower. Well, maybe they do because the average coupon's 3.5%, right? Roughly 3.5%. So okay, current mortgage rates are 7, roughly. So are you really going to sell your home? You extinguish that mortgage at 3.5, go get another home, get another mortgage at 7. The economics of that are pretty tough, right?
Yeah, that's right.
And so that's what you mean by interest rate lock. People are locked into their home, even if they hate their home. They love their mortgage. They're not gonna. At least not unless they're. Life happens, and it will. That may be. We still have house price declines occurring in our forecast because over time, over the next couple, I don't know, 2.5 years, because divorce, death, children, job change, people got to move. And, once they have decide they've been putting off those things, those things happen and they've been putting off moves because they don't want to move, but at some point they're going to have to move. And when they go out to sell, if at the current house price, which is so elevated, and at the current mortgage rate, things are just not affordable, they're going to have to start cutting prices. So we expect prices to still come in. Although our peak to trough decline in house prices now is not as significant as it was before, right?
That's right.
Yeah. At the worst of, at the height of our pessimism around house prices, what did we have peak to trough decline in prices? Do you recall?
It was close to 10%.
Close to 10. Yeah, that's the entire market. Yeah. The Fannie Freddie market, the FHA market, the bank, the market that's non-government. Yeah, right. Okay. So that was a surprise. And that may go back to consumers too, to some degree, right? The fact that housing values have held up means that people's housing wealth is also held up, and another reason for them to be a little bit more confident about going out and spending. By the way, going back to your point about labor force participation, the one place where I have been surprised about labor force participation is the fact that people who have retired have not come back into the workforce to the same degree as they have historically in the post-pandemic period, right? So we're getting a lot of retirements. The boomers are retiring, and typically, historically, when people retire, many of them come back in to look to get work, either perhaps because of a lifestyle choice. They just say, I just don't like retirement. I want some kind of work, and or financial reasons. I'm not as prepared financially as I thought. I need to work a little bit longer. I need some income. But that's not happening this go around. It may be because people are wealthy, right? I mean, house prices are hanging in there. Stock prices are almost back to their previous record high. So they're saying, well, I'm fine. I don't really need to come back in.
Yeah. Although I think though, so you're right. They haven't come back to the extent that they were at prior to the pandemic, kind of between the great financial crisis and the pandemic. The labor force participation rate of the folks over 65 was pretty high. But if you go back a little bit further, I believe it was lower. I think we're getting back to that historical norm. If you go back into the 90s.
I don't think that's a fair comparison, though, because you got to look at the distribution of ages of people in retirement. You've got a big chunk of folks that have newly retired. That's the boomers. You go back in the 90s, the average age of a person in retirement, that was a lot old. They were a lot older back then, right? Because you've got this wave of retirements occurring. So I'm not sure.
So you want to look at the 65 to 70.
Exactly. Yeah, that's what I want to look at. Yeah.
Take a look. I'll take a look.
Oh, you've got the data. Oh, damn.
I'll find it somewhere.
I could be wrong. I could be wrong. No, I think that's.
You might be right.
Yeah. Okay. So.
Are they going to come back in though, or is this permanent? You think?
The longer it goes on, the more I'm thinking this is going to stick. And I do think it goes back to asset prices. I think it does go back to stock prices in particular, and it goes to housing values and the cash that people have that they did save. There's still a lot of excess cash for high middle and high income households. And the other interesting thing about boomers is they have invested more of their wealth in stocks than previous generations. And unlike previous generations, as they've aged, they've not left the stock market. They've continued to invest in the stock market, which is, kind of counter to a lot of
Theory.
personal financial advice, right? You're supposed to take less risk, but people don't want to do that. They're very comfortable with the equity market. It's gotten a lot easier to invest in the equity market. You got all these trading platforms and everything else. So, it's just a lot easier. And so now that stock prices are so high, elevated, that, I think there's a lot more wealthier boomers out there than has been the case, in previous generations. And that's less likely they're coming back in. Yeah. Hey, okay, the surprises are the resilience of the economy. You mentioned consumers. I don't think that was a surprise, but you get surprised about lots of things. That didn't surprise me. But the resilience of the labor market, that surprises me. If it's real, if it ends up being real.
Yeah. Yeah.
And then house prices. Anything else that happened here recently, first half of 2023, that's been a surprise to you?
Well, I think if I'm honest, the banking mini crisis
Yeah.
was a surprise, right? Could have expected
that it
something.
happened.
That it happened, and it happened so quickly and to fairly large institutions. We're not just talking about a few small banks. I mean, Silicon Valley was a huge bank, right? So yeah,
right.
that was a bit of a surprise, certainly.
Yeah. That came out of no. For me, that was my most disappointing miss, right? Of all the things that I say my biggest forecast error in the following sense, that I actually talked about the bank before the crisis. I talked about the banking system as a basis of strength in the economy. One of the reasons why I didn't think we'd have a recession, because the banking system was on such fundamentally strong ground. So I got that wrong. And, it's a good lesson, for me, that I learned every 10 years. And that is, look at the distribution. What I mean by that is, if you go look at the averages or the medians of measures that are reflective of the health of the system, the banking system, financial system, you can look at them, you go, the system's in great shape, right?
Yeah.
I mean, the level of capital is extraordinarily high. It's risen meaningfully since in the wake of the financial crisis and all the regulatory changes, Dodd-Frank and everything else. Liquidity is much, much better than it was historically. Again, going back to those changes, underwriting has been really actually very good, since the financial crisis. Banks have been very cautious in their underwriting, the lending standards that they, impose to extend out credit. So I looked at those numbers and I go, and even the profitability of the banking system, right? I mean, one of the things that I find so amazing is, despite the higher levels of capitalization and despite the more restrictive regulatory environment and despite the liquidity, the demands for higher levels of liquidity, the return on assets, the return on equity of the banking system is not much lower than it was prior to the financial crisis. And of course, in the part of the financial crisis, the world had lost their minds, and the banks had extended out way too much credit. Underwriting was way too weak, and that juiced up their return on equity and assets. So, accounting for that, the system had returned, completely back to the profitability that prevailed prior to that. By the way, that brings up another point about now the system is being required to hold even more capital in the wake of SVB and banking crisis. We can come back to that if you'd like. But the thing that I missed, and in hindsight, it's always like, you idiot, how could you have missed this, is the distribution, right? If you look at, the distribution across all the banks, if you just had simply done a scatter plot of all the banks on the x-axis, share of deposits that are to uninsured depositors, on the other axis, the share of unrealized realized losses on securities portfolios because of the increase in interest rates, they're way out on the, standing all by itself, obviously screaming, I got a problem, was SVB. SVB. Now I would have actually, in all fairness to me, to me,
That's what it's all about.
It's all about that. SVB was a $200 billion bank. Like, hand me a break. If that thing goes belly up, would you have really thought that it would trigger the deposit run that occurred across the banking system? Probably not, right?
Yeah.
Probably not. Even if you'd seen that, and of course I missed that, but that's a cautionary tale. We got to look at the distribution, particularly when it comes to things like the financial system. Can't just look at the averages. But that's my biggest forecast, mistake, I think. And but having said that, I'll say one more thing because I'm saying a lot. The fallout, the economic fallout from the banking crisis has also been a lot less than I would have thought. No?
Yeah. At least
Right?
so far. Right.
Well, I mean, here we are. We're like, what? April, May, June. We're 4 months away, since the crisis. So what are you thinking?
Well, if the tightening of the standards, lending standards, right? Maybe that hasn't really filtered through because of the balance sheets we talked about. If consumers still have cash and businesses have cash, they haven't really needed to borrow to a large degree. As loans come due, as those resources get depleted, that may be the time when you actually feel the pressure.
Yeah, but on the other hand, you look at because we get weekly data on loans outstanding by loan type, credit cards and construction land development loans and multifamily mortgage loans and commercial industrial loans. And that doesn't seem to show any meaningful weakening. Maybe a little bit on the margin, but I don't see it, in the data, at least not so far.
But not yet, because the
rates takes time.
Rates are just like the mortgage market, right? The rates are locked in for a period of time.
Yeah.
When the businesses actually need to refinance
or I see
more capital.
Yeah.
Later this year or next year.
I see.
That could be when you see
the real problem happens.
Yeah.
Like when that multifamily property owner, his mortgage comes due. Her mortgage comes due, and she goes to the banker and says, "Hey, I need to refinance this mortgage, roll this mortgage over." And the banker says, "Oh yeah, I'll be happy to do that, but the interest rate is 400 basis points higher. The LTV is much lower." That's what you're saying.
That's right. That's when it could.
Yeah.
The real impact could be seen.
Okay. All right. Okay. So I gave you my biggest forecast regret, that I completely, and when I say missed the banking crisis, I remember giving a speech at a Moody's conference. I think it was the day, maybe it was 2 days before SVB failed. I will say we had this risk matrix, which shows, encapsulates all the risks we think that exist to the economy. It was in the risk matrix. It's just I didn't even call it out. I felt so dumb not doing that, but I missed that one. But it's okay. That's me. I did my forecast, mea culpa. What about you? What's your biggest?
Oh, I thought I gave it the existing home sales and the
that's your worst
home price resilience for the first half of this year. We're just talking this year, right? So
I think you've got many more than that, my friend.
What are you talking
about? Really? Okay. All right. That's it. That's what you're going to give me. The house price one. All right. Okay. Fair enough. All right. Let me ask the flip of that. What are you most proud of? What forecast are you most proud of?
Also house price forecast before that, right? The fact that the house prices were coming in, right? Last year, there was a lot of pushback that no way the prices could come down from 20% year-over-year growth to anything close to zero. So,
oh really?
That's when I'd be more.
Hold on, I don't understand. So you're saying forecasters out there weren't forecasting house price declines at all?
No, very modest.
Oh, is that right? Very few people were forecasting house price.
Last year, we were getting quite a bit of heat that we were calling for.
Boy, that seems like that was so obvious that was going to happen. But no, okay, all right, interesting.
Yeah.
Because why? Because the prices, I think in part because of the momentum, prices had been going up throughout 2020, 21, 22. How could they go from 20% year-over-year growth to I
zero,
see.
Right.
Oh, I missed all that. So people were banging on your door saying, "What are you doing?"
That we were being
I didn't realize.
too pessimistic. So
Oh, okay. All right. Okay. Very good. Okay. So let me ask you this. A lot of this now we're kind of forward looking here.
Yeah.
We've been kind of retrospective now, a little bit more forward looking. Of all the things that people are hand wringing about, and I've been out talking to clients. As I said, I just got back from a long West Coast trip, listening to folks. I know you do. You talk to clients all the time. What do you think is the most? What are they most concerned about that they just it's just misplaced? They're overly worried about what's going on. They're throwing out
Oh, there's a
risks
long
and
list. I probably at the
yeah.
top I would put CRE, commercial real estate.
You'd say they're overly concerned about commercial real estate as a threat to the economy.
Exactly.
Oh,
I
okay.
think that's I think it's changing, right? I
Okay.
think people are coming around to terms that yeah, there are issues with the commercial real estate market, but it's going to play out over time. It's still relatively small market, unlikely to hit the economy more broadly, but certainly for a while there were a lot of concerns that this was it. This is going to be the straw that breaks the economy's back. So I think those fears would have been a little bit too much, right?
Overdone.
Not overdone, right? Not that we shouldn't be worried. That
Yeah.
certainly there's an impact, but from a
So
macro
so flesh
perspective.
that out. So why shouldn't people be worried about CRE, commercial real estate?
Well, in terms of the impact on the banking sector, I think that's where people think the risks are really heightened. Just kind of an extension of the banking risks that we talked about earlier. Banks do have exposure to commercial real estate loans. If the values of those loans go down, then there could be problems in terms of the solvency of their balance sheets. Banks certainly do have some exposure, but it's not as large, perhaps, as a number of analysts suggest. The underwriting on CRE loans by banks has actually been fairly conservative after the Great Recession. So, it could be a loan to value ratio of 50%, right? So there's quite a bit of buffer, I would say, in terms of the depreciation in those CRE assets that can go on without actually causing massive losses for a bank. So that would be the first thing I would point to. And then secondly, I do see this as playing out over time, right? This isn't, so far, I haven't seen the trigger that would cause all CRE prices to collapse suddenly, unlike what happened with the residential mortgage market during the Great Recession. These are, the leases are staggered out over time. The mortgages also come due at different points in time. So I think it'll be a rolling issue, if you will, but not that critical Minsky moment kind of sudden crash that goes on. So a long, slow bleed rather than a direct impact on the economy.
Yeah, I agree with you. I just to put a finer point on it, give a couple of numbers. I mean, the total amount of CRE, commercial real estate mortgage debt that's coming due this year, 2024 and 2025, is about 1.2 trillion. Of that dollars, outstanding that's coming due. Of that, 400 billion is owed to the banking system. The rest of it is, REITs and commercial mortgage-backed securities, sovereign wealth funds, all kinds of insurance companies, a bunch of stuff. It's widely dispersed around institutions in the global financial system. And of that, 100 billion is mortgages backing office properties, and that's really where the problem is, right? It's really very specific. It's office properties sitting in downtown areas of big urban centers, where we live, Philly. I think occupancy here is, I don't know what, 60-70% probably, and not rising. People aren't going back in.
If that.
Yeah. You can look at the Castle data. I can't quite remember. Boston, New York, DC, Chicago, Seattle, Bay Area is, the poster child for all of the mess. Southern California, where I was, there were some high profile defaults, very recently. That's where the problem is. So 100 billion, people say 100 billion, that sounds like a lot. No. I mean, if you look, I think total, the total, I'm making this number up, but the, total assets sitting in the banking system, I think it's 20 trillion, something like that. I mean, some outrageous, it's this 100 billion is nothing. So now having said that, let me try this out on you, the kind of the risk scenario, because you just kind of laid out the base case, optimism, and you got to think about, what could go wrong. It does, going back to the distribution, looking at, institutions, I think the typical bank, has maybe 10 to 15% of their assets in CRE, total assets, loans, securities, the whole shooting thing match. But there are, a fair number of small banks that have a much higher share, 25, 30, 35%. And as a share of their capital base, their equity, they're like, tier one capital, it could be close to 100%, could be over 100%, like that. So, you have one or two properties that, go belly up, default on the mortgage, and it's owed to a smaller institution. Those institutions could get into trouble. Now you're saying, okay, why should I be worried about that? They're too small. They're not too big to fail. They're not systemically important. But I would point out, given our experience back in March, I'm not sure, what systemically important means anymore, because if people are nervous and start pulling their money out, even if a smaller bank fails, then everyone's too big to fail, right? So you could get into and right now people are on edge, obviously, depositors are on edge. I think I told the story about my 93-year-old mother-in-law who's got some cash sitting in the bank and, well below the deposit insurance limit, asking me, whether she should take her money out. And I'm saying, no, don't worry. And then she's asking me what I do for my, for a living, just to make sure, I'm credible, that kind of thing. So, if she's nervous and she's watching CNN, then, every news outlet was, saying the same thing, that people are very nervous and you could get a deposit run. Yeah. Does that sound like the most likely risk scenario? If things go off the rails, that's why it would go off the rails.
Yeah. Not that JP Morgan or a large institution gets into trouble, but yeah, even a small one, because we are in kind of a fragile psychological state here, that it may not take much to cause more bank runs.
Right. Oh, and just one other reason why I'm not that nervous about it is, the big banks have had to stress their portfolios or commercial real estate portfolios under the stress testing scenarios, the so-called CCAR stress scenario. And I think, correct me if I'm wrong, Cris, because I know you know this data really well, the peak to trough decline assumed in last year's stress test was 40% on CRE.
That's right.
40% peak to trough. I mean, so that would mean it had to be almost Armageddon, for prices, because office prices would probably have to go down by 75, 80%, something like that.
That's right. Because the 40% was across the entire
CRE
multifamily
portfolio,
industrial, properties that actually are
retail, hotels, the whole shooting match. Yeah. Okay. That feels like that. And you're right. Also, I think talking to people, they're getting less exorcised by that risk, because as they work through the numbers like we just did, they're nervous, but they're less nervous than they were.
Yeah. So what are you hearing?
Well, to answer that question, what out there is bothering people that might be overdone, I think it's student loans. The student loan debt moratorium, because I've been getting this question a lot too, comes to an end. Payment moratorium that was put in place during the pandemic, that ends here. And I think the first payment due of student loan borrowers is October. If you do the kind of calculation, by our calculation, using Department of Education data, 22 million student loan borrowers will have to start paying. Their average monthly payment is, say, $275, $300 a month. You do the arithmetic. That means if all those student loan borrowers started to pay and didn't have other financial resources, then and had to cut back on other spending or stop paying on other debt to make that debt payment to on their student loan, it's 70, maybe 75 billion per annum. So that, 75 billion is, a quarter percentage point of GDP. That kind of gives you a sense of magnitude.
Yep.
So if they all stopped in October, November, December, the fourth quarter, and you take a quarter percentage point annualize on a quarterly basis, that's 1% of GDP. Maybe you get given all the things that we know that are going on, maybe you get a negative GDP number in Q4. But that's a vast overstatement of what's going to happen, because a lot of student loan borrowers have other financial resources. And here's the other thing. I don't know. I'm not sure how many of those 22 million borrowers are actually going to start paying on their debt, because as we learned, President Biden, through executive order, told servicers that they cannot report delinquent student loan borrowers to the bureaus. So there's no penalty to the borrower for not paying, at least for a year. I think this was in place for a year. So I'd be surprised if 22 million borrowers started paying on their debt. I mean, it could be half that, it could be a quarter of that, it could be, shadow of, what they're expecting. So, it's not great. The timing isn't great. The economy is soft and getting softer, and probably will be at its softest point late this year going into next. But I don't think by certainly not by itself that it's that big a deal. What do you think?
Yeah, I'd agree. That's what I've been saying as well. That certainly doesn't help, right? And given some of the other pressures we've talked about, right? If indeed savings are running out, it doesn't certainly point a positive picture, but on its own, it's not enough to really be the root cause of the next recession.
Right. Okay. I want to also ask, and maybe before we answer the question, maybe we should play a little bit of a statistics game, which is going to feel a little weird because it's just the two of us. I don't know how that's going to go, but we might give it a shot. But I do want to ask, what is the thing that people are missing? The kind of the standard you always get, what keeps you up at night question. But before I come back to that, you want to play? Do you have a statistic? I got one.
I have one.
You have one?
I have one. We kind of alluded to it earlier, but
okay.
Maybe that makes it easier. But
not really, because we've covered a lot of ground already. I don't know how helpful that is, but okay, fire away.
All right. 117.
Oh, and I should say, wait a second.
Yeah.
To the listener, I'm taking it for granted, but they know what the game is. The game is we put forward a statistic. The rest of us, meaning me in this case, try to figure out and not look stupid, what that statistic is. And I'm, through cues and deductive reasoning and, clues. And the best statistic is one that's not so easy. I'm going to get it immediately, and not so hard I never get it. But so fire away.
117.6.
117.6. Is it a economic statistic that came out this week?
It did. It came out on Monday.
Oh,
it is an index, just to give you the units.
Well, I was going to say that, to establish a little credibility. It's not the conference board survey, a leading indicator, coincident indicator. No, I didn't think so. No. By the way, on that one, that's getting to be pretty weird, right? Because the leading indicators, as measured by the conference board, have been declining for well over a year now.
Yeah.
But where's that recession, my friend?
Recession is coming.
Okay. Here's what I want to know, and I haven't been able chance to do it, but can you go back and look historically? Has there ever been a case where the leading indicators has fallen for so long, and a recession not occurred?
No, it's got a perfect track record.
Okay,
at least so far.
And this started falling, I think, well over a year ago.
Yes.
Has that ever happened where the recession has followed that? So,
with that much of a lag? I don't believe so, but I'll double check. There might be some cases where, I've been looking at the magnitude. We've never had a case where the leading economic indicators have fallen so much and not had a recession within a 6-12 month period. But
just so folks know, the conference board puts these so-called leading indicator, coincident indicator, lagging indicator. It's a compilation of different economic financial statistics that historically have tended to lead be coincident with or lag the business cycle, lag recessions.
Yeah.
And as you can imagine, the leading indicator is heavily dependent on the shape of the yield curve, the treasury yield curve, and that's been inverted, which historically has been a very good, prescient predictor of recession. So that's driving a lot of the train. Also, I think it also includes University of Michigan Consumer Sentiment Index, which is, a little saying something very different than some of the other confidence measures, including the conference, which is a weird thing.
Don't they use the conference board
Oh,
sentiment?
I was just going to say, do they use the They should probably.
It would be odd if they.
I don't think they do, though. Now that I say it, I just said it, and I'm not sure. But that would be odd, wouldn't it? But no, they would pick the one that is the most prescient, wouldn't they? Historically, I don't know. Can you? We should find that out.
I should double check.
Wait,
that would be
weird.
That would be weird.
Oh, it'd be really weird. We should check it out. The other thing, though, that may be a reason why the leading indicators are a little off this time compared to previous. They're very heavy on interest rate sensitive sector activity, housing, manufacturing activity, right? And those two sectors have held up a lot better than anticipated, for lots of different reasons. And so they may not be as good a leading indicators may not be that as good a leading indicator because of, those what's the idiosyncratic kind of environment that we're in. Okay. But going back to your statistic.
Yeah, I like how you bought yourself some
delaying. Is it a housing related statistic?
It's not.
It's not.
It's from the Fed.
Oh,
that helps. Federal Reserve.
Oh, industrial production?
Nope.
Because that's an index.
It is.
It is. Did it come from the Board of Governors?
Yes, indeed.
Is it a monthly statistic?
It comes out weekly. Oh, no, even daily. Sorry, daily.
Oh, a daily statistic from the Federal Reserve Board. Is it financial related?
Yes.
H10. H10.
Does that help?
No, you know what? I don't know H10. Is it financial conditions index or something?
No.
Or no? Damn, I should know this.
H10 is the foreign exchange rate table.
Oh, it's broad trade weighted dollar.
Yes. Yes.
Nominal.
Yes.
Nominal broad trade weighted dollar. Oh gosh, there's got to be a lesson in you picking that statistic. You just picked that to trump me.
We kind of referred to it with the
we did?
American tourists.
Yeah, we did.
Strength. So the dollar is weakening.
Yeah.
Right. Relative, it was really strong a year or so ago. Right. It is weakening now. So something to watch, but it's still relative to where we were prior to the pandemic, still relatively strong. So as we think about inflation and implications of a strong dollar, right? Certainly a weaker dollar could put some upward pressure on that inflation.
But again, weaker, I mean,
it's all relative. I get it.
But, I mean, it's well above its long run average, right? I think.
It is.
Yeah.
Still. But it's
still strong.
It's fallen pretty swiftly now.
Really? Okay. I'm not so sure. When you say swiftly, against what exactly?
Against itself. All right.
Against what other? It's a broad trade weighted, so it's got all these other basket of other currencies. What is the dollar?
Well, we mentioned the euro appreciating.
Yeah, a little bit. Okay. Yeah.
Well, again, I'm not saying that it's
you're
collapsing.
Stretching, buddy.
It's not collapsing, but it's
weaker
than...
Okay. All right. Fair enough. All right. That's the fodder for a future discussion.
Okay, fair enough.
Yeah, I'm not so sure. Okay, I got a statistic. I don't know how fair this is.
It's probably more fair than,
but it's more fair than the one you just gave me. And this goes to, I'm going to give you a hint. It goes to a surprise, a positive surprise about the economy. That is. Well, I'll stop there. I can give more, but I'll give you the statistic. $194.3 billion. $194.3 billion. It is an economic statistic that is produced by I'm not going to tell you who, but by the government. It didn't. I don't think it came out this past week. I think it came out the week before. So I apologize for that. Yeah, but it's a really good one. And it's apropos to the conversation at hand because it is a surprise, a very meaningful surprise.
Gosh,
at least to me, and a reason for why the economy is held up better than expected. I'll give you one more hint. It's no, maybe I shouldn't give you that one. It's produced by the Bureau of Census. That should help a lot.
Oh, okay.
Yeah, it's monthly.
$194 billion.
194.3 billion. This is as of May, the May data. Yeah. And, we were talking about it in the context of leading indicators and, how the interest rate sensitive sectors are holding up better than has been the case historically. And this is one reason why that's the case.
The housing construction.
Oh, okay. You got half right. You got the construction right. Yeah.
Oh, not just housing, but
no. Well, 194 billion is too small for all the construction.
Yeah, that's
right?
true.
This is annualized. It's annualized data. I think annualized construction put in place is well over $1 trillion. Yeah.
Which sector?
Which sector? Oh, this is you should know this one. Oh, no, now you should know it. Yeah, what's booming in the construction sector?
Oh, industrial.
Yeah, industrial, manufacturing, construction put in place, 194.3 billion. Can you believe it? 2 years ago, you go back to May of 2021, it was like 75 billion.
Yeah,
that's 75 billion to almost 200 billion, and it's going straight up. It's almost vertical. It was so cool, right? Pretty amazing.
Yeah.
And that goes to the, a lot of government support, the CHIPS Act in particular. That's the piece of legislation that was passed, a little over a year. I think it was a little over a year ago, that provides tax incentives for global chip producers to, manufacture here in the United States. And it's pulling in a lot of construction, a lot of the new manufacturing construction activity. Actual fab plants are being constructed. In fact, I just saw TMCS, that's the large Taiwanese chip manufacturers building a plant in Arizona. They were talking about this when I was in Southern California. They are going to be delayed in starting that plant, going back to some of the issues we were talking about earlier, because they can't find skilled labor. Yeah. This is so funny. So this comes out of one of the conversations I was having with one of the banking clients this past week, because they're following it very carefully. And he was saying, because TSMC said they're probably gonna have to bring in some Taiwanese labor engineers, here to help finish this thing. Yeah. He goes, I don't know how that's going to work at all. They're never going to get any of those Taiwanese workers to come, because the closest Chinese restaurant to the fab plant is 7 miles away. That's what he said. I go, that's pretty precise. That's pretty precise. Then he said, well, yeah, and the closest decent Chinese restaurant is 20 miles away. 20 miles away. And by the way, there's no direct flights from, I think he said, Phoenix to Taipei, which surprised me a little bit, but but he knew this. I thought that was pretty, took this very seriously. So what do you think? That was a pretty good statistic. That's a pretty interesting.
That was a good one. And you were very generous. You were generous with your hints. So,
and I was generous with my hints. Yeah, generous with them. Okay, let's go back. Have you noticed we've been talking with each other on this podcast for about an hour? It's just the two of us. I'm not even sure we need Marisa anymore. I'm just saying. Oh, really? Okay, that was rude.
Oh, come on.
Okay. We can only do this so often. We need Marisa. We can bring her back, please. Where is she, by the way?
Hawaii.
Oh, good for her.
She's doing detailed economic research into the economy.
Okay, good for her.
I expect a full report when she's
done. Well, Hawaii is an interesting economy. That's a topic for another day, though. Yeah. Okay, let's end this conversation this way, because it's always part of the conversations we have. What is it that people are missing on the downside? What could go wrong here? What should people start being focused on that they're not focused on? What do you think? You must get that question all the time.
Yeah, for sure. I'm going to go back to my upside surprise, which you didn't think is an upside surprise, but that was the consumer. And I would say the consumer credit is another area.
Blah, blah, blah.
Focused on the downside.
Yeah. Really?
Yeah.
What's bugging you there? Other than I just assuaged your concerns around student loans. So what's the deal? What's
Well, I'm
bothering you?
not concerned about student loans. I just don't think it's the
I'm not
trigger.
concerned. Okay. I
I
hate
don't think
those.
it's the concern, or I don't think it's the trigger for a recession, but I think it adds to pressure on consumer balance sheets as you know, labor market does slow. Wages are going to come in, right? The Fed is going to guarantee that, and certainly that's going to start to put more pressure on consumers. I think the excess savings we've been talking about have been a real boon, but those are running lower and lower every month. So I think it's going to get tighter here, and we're going to be walking the tightrope. And I worry about the consumer credit delinquency default rates starting to really ramp up here, and that could have a real chilling effect from a not only a banking standpoint, but even a psychological standpoint. If you start to see a lot of defaults and delinquencies, right, might lead to consumers thinking twice about taking on additional credit or continuing that spending at the levels that we've talked about.
Oh, so when you say consumer credit, precisely what do you mean? You mean bank cards?
Anything outside of mortgage, really.
Oh, well, so
So
you're throwing in student loans, auto loans,
student
bank
loans, auto
cards,
loans, bank card, personal loans,
unsecured personal loans,
right?
so-called consumer finance. And so you're saying clearly delinquencies are rising here pretty quickly,
That's
defaults. Right. Part of that is the stress that lower income households or financial stress that they're under, in part because of the inflation they've blown through their excess saving. Also, it goes to, we've talked about this in previous podcasts, score inflation back in the particularly
21, 22.
Right. That's the bad so-called vintage of loans. That's where the delinquencies are, really popping.
Right.
You're saying that this could get meaningfully worse, even if we don't go into recession, could get meaningfully worse. But obviously, if we go into recession.
Yeah, I see it getting worse. Certainly, it's not going to get better until we move through these these particular vintages. Right. That's going to take another year or two. So expect the delinquencies to get worse, but the risk is that they really take off if there is some other weakness out. If the job market slows considerably, if you do start to see unemployment ticking up a bit further, right, that's going to put additional pressure on these markets and cause those delinquency and default rates to rise, and that's going to cause the banks to start to pull back even more, I suspect.
Okay, fair enough. I mean, the dollar amounts are, I guess, they're consequential. About $1 trillion in bank card debt outstanding. I think consumer finance is what, 250, 300 billion, probably.
Yeah, not that large.
Yeah.
Autos is significant.
That's 1.5 trillion. And student loans are another 1.5, 1.6. So you add that all up, that's real money. That's what you're saying.
Yeah. And it's really what the impact on the margin, right, in terms of the diminished spending in an economy that might already be facing some headwinds.
Boy, if that's the worst you can come up with, I'm feeling pretty good. I mean, I agree. I mean, it's definitely a soft spot and going to be some issue, but it already feels like lenders have tightened up. Loan growth is slowing. Still growing quickly, but starting to slow. You pointed that out in the last podcast. You were pointing that out, right? Yeah. And it feels like delinquency is starting to top out. No, you don't think so?
I don't know about that.
Okay, interesting. Okay, because it's now it is back to pre-pandemic, right?
Yeah,
maybe even a little higher than pre-pandemic
in some of the markets. Yeah,
in some of the markets. Yeah. Okay, fair enough. Okay, I got two. Right. One's near term, one's a little bit longer term. Actually, I can give you three. One that's short term, intermediate term, long term. Actually, I can give you four. No, I could give you four, but I don't want to depress people. Near term, government shutdown, right? I mean, I think there's a growing possibility that lawmakers can't come to terms before the end of the fiscal year, which is the end of September, pass a piece of legislation that funds the government. So we could shut down. And my sense is that we could stay shut down for the entire fourth quarter, because the real pressure point politically is that if they don't come to terms on January 1, there will be what's called sequestration, a 1% cut across all discretionary spending, both defense and non-defense. And I don't think anybody wants that. both Republican and Democrat, so they'll come to terms. But that that the Republican House could want to send a message here because they're pretty strident and decide, hey, say we're going to shut down for a full quarter. If it's a full quarter Q4,
Oh
that
yeah.
adds up. That adds up, particularly with the student loan thing I just mentioned, which adds up. So Q4 feels a little iffy to me at this point. We may get that could send us into negative GDP territory. So I worry about
Yeah.
that. And so
Yeah.
that's
I was thinking a few weeks, we brush it off as usual, but yeah, if it's a
no,
quarter.
yeah, I think it could be that long.
Oh,
Could be that
okay.
long. Here's the intermediate term concern, and it goes back to the financial system, not the banking system, because I think the banking system is on much sounder ground because of the policy response to the crisis that occurred in March. The Bank Term Funding Program the Fed established to allow banks to borrow against their security holdings at par. The willingness of regulators, Treasury to ensure all depositors come push to shove, those kinds of things. They're resolving troubled institutions very rapidly. They're not letting them fester, which is, I think a good thing. From the perspective of safety and soundness, and making sure the system doesn't fall apart. It's the non-bank part of the system, the shadow system, particularly the part I know best. And I'm worried about all of it in part because I don't understand it, and it's not transparent. It's very opaque. You don't have really good data on big chunks of the private credit market, for example, leveraged loan market. But I'll point to the non-bank mortgage industry. Yeah, that makes me a little nervous. Because they're under a lot of pressure because there's no, as we talked, interest rate lock, no home sales, therefore no mortgage origination, and that's their business. That's how they make their money. And if there's no origination, they're going to start to see some failure there. And there's no, the institutions, they're mostly intermediaries, but they do have some risk and they do have some capital, but it's very thin capital. But here's the real kind of vulnerability. They're funding, they're non-bank. They don't have deposits. So they rely on warehouse credit lines from the big banks and, capital markets for their funding. And you could easily see that under some scenarios drying up. And if they can't get funding and can't make loans, then they go out of business very rapidly. And if they're small in the grand scheme of things, so they're not systemically important. But if you get a rash of failure, and then creditors and the other bigger non-bank mortgage companies start to say, "Hey, I don't really know what's going on here. It's not as transparent as I thought," and they just kind of run for the hills and stop providing funding or equity, then the system kind of shuts down. And these guys are a big chunk of the mortgage market now, I think, right? They're like 75% of the mortgage market, in terms of origination volume. If they stop lending, then the housing market shuts down. Then those house price declines we were talking about,
then
we're going to get some pretty big price declines. And then you can, then of course your mind can go in lots of different directions pretty fast. So, and I guess adding to that is, how does the government respond to that? What's the response? I mean, maybe the Fed could establish a facility, but that's pretty tough to do. Maybe FHFA, which is the regulator for Fannie and Freddie, tells the Fannie and Freddie and to establish, a source of funding for the non-bank mortgage lender. I don't know. I'm,
it's
right?
Uncharted territory there, right?
Yeah. Yeah. Okay. So
You
you
would think
agree? You agree
think that you would think that the Federal Home Loan Bank system would be
they can't.
But these guys are not. That's the irony, right? Is the mortgage originators today are not part of that system, right? So
yeah, because they can't. I mean, the way the system works, the Federal Home Loan Bank system, they take securities as collateral.
Exactly.
These guys don't have the collateral. They post the collateral to get their lines of credit. So there's no way of there. So the Federal Home Loan Bank isn't a source of liquidity either. So you would agree. So is that more of a concern to you than the consumer credit?
Oh,
I'm just,
I guess,
if you had to rank order.
I guess I'm still more concerned about the consumer.
You are. Okay.
Yeah, just in the sense that there are
Because we
a
know that
number of,
that's a problem. We know delinquencies are rising. The other we
yes,
don't know. It's more speculative as
it's
to
more
what.
speculative. And you're right. There's concentration in terms of originations, but there are a number of them out, a number of these originators out there. So
Yeah.
if one goes down, there are others that could step up to fill the volume. But I take your point regarding the nature of a run, right?
Yeah.
If
Yeah.
suddenly a large mortgage originator gets into trouble, suddenly all the other ones become tainted. The banks don't want to lend necessarily to any of them until they figure it out. The system could really seize up for a while.
Yeah. Okay. You want one more, and then we'll call it a podcast.
Go for it. Go for it.
AI.
Oh, that was the one I was going to mention if we were going to go long term.
Well, I mean, because I get that now every
All the
single
time.
meeting,
Yeah.
right? What
Yeah.
about AI? Okay. So actually, on this trip I had out west, I had Dante with me. Listeners know Dante. Dante is a great labor market, great economist who comes on every Jobs Friday. And at the, I had him come because I wanted him to kind of shadow me and just, see how this is done,
Yeah. Yeah.
because he's going to be doing this, out meeting clients a lot more than he has historically. He talks to clients all the time, but he hasn't done a lot of traveling. So at the last dinner we had, which was in Southern California, someone, of course, asked about AI, and I asked him to answer the question. Did a great job. So I'm going to turn that back to you. How would you answer the question around AI? How big a concern is that? I mean, obviously the concern is it's dystopic to the labor market, but I'll turn it back to you. How would you answer that question?
Yeah, dystopia is certainly one version of the picture you can paint here. I guess I would, to answer the question directly, in terms of the short-term implications, I see them as very limited, right? AI, like any technology, takes a long time. It's going to take some time to be fully integrated into the economy, right? You have to train people up on AI. Maybe the learning curve for using AI technologies for certain knowledge workers is shorter than computers in the past, but still, it's not going to be instantaneous. So there's some training that needs to be conducted. People need to figure out how to use this new technology effectively in their job. So I don't see this as a 2023, 2024, even 2025 type of risk. This is longer term, right? It's certainly going to have some structural, or has the potential for some structural changes in the economy. So I think that we could take off the table in terms of the immediate effect. There's a lot of buzz around AI right now, but just go back to the internet. There was a lot of buzz around the internet too initially, but it took years, decades to actually bring that up to speed. So I would remove the short-term risk. Longer term, the risks really depend on how this AI project works itself out. I remain quite optimistic, though, that AI is coming at the time when we actually need it, given all the lack of labor that we have. Right, the issue with the labor market today and into the future is going to be a real lack of workers to fill all the positions that are available. And so we need these productivity enhancements to continue to grow the economy, continue to grow productivity, and ultimately continue to grow wages. So I see this as a real benefit to the economy overall. Will there be disruptions? Certainly, but there always are disruptions in the economy with any new technology. So I don't see those as being any worse, though, with AI than with other technologies, meaning over time, we will adjust. This isn't going to be an immediate shock where we lay off all the programmers in the country and we just go to AI. It's going to be something that gets integrated with industry over time, makes people more productive. And I think you'll barely notice at the end of the day the real implications in terms of layoffs on the economy more broadly, because it's going to play out over a number of years.
Yeah, I thought.
How'd I do?
Well, yeah, well said. Yeah, I agree. I mean, I say what I preface the response to the question by saying I forecast lots of things. Some things I'm confident in, some not so much. This one I'm not so much because
Sure.
this is a tough one. like all technologies. But if history is a guide, and we always use history as a guide, everyone does when they forecast, they go, okay, what happened in the past, I'm going to use that as a basis for predicting the future. And you go back and you look at technologies, big technologies, and like the internet or electrification, it takes time for those technologies to diffuse out into the economy and to have big impact. And actually, it doesn't really have a big impact until new businesses form and optimize around that new technology. That existing businesses that try to gerrymander the technology into their existing business practices, that's problematic. And in fact, to your point, could be actually counterproductive, at least for a time, because they're going to, oh, what do I do with this thing? How do I organize myself? How do I take advantage of it? I'm spending all these resources on it. And by the way, the initial impact could be positive, not negative, because companies have to invest in the underlying, physical hardware and software and people to be able to actually do it, actually implement it to bring it on. And so it's not this labor saving thing. It actually may be creating demand for labor in the near term, not hurting it.
Yeah, good point.
Yeah. So I agree with you. I think it's going to take some time to diffuse out into the economy. But, having said that, like the internet probably added, in the 2000s, when it really kicked into high gear, probably added half a point, maybe a point to productivity growth. Productivity growth in that period was 3% per annum. So, I think that, was the internet. Electrification, if you go back into the 20s, same deal, could have been a half a point to a point. So if you told me over the next 10, 15 years, you get a period of, 5, 10 years of, 3% productivity growth, I don't know that I'd argue with you. That's a real possibility. But I don't think that's dystopic, dystopic in the sense that you throw so many folks out of the work so fast that they can't find other jobs. And here's the other thing. These technologies, they create wealth, right?
Yep.
And that by creating wealth, they create more demand for stuff we can't even anticipate, because, we can't even think about all the things that we're consuming now that weren't even in our mind's eye, back before the internet was in full swing, right? Mobile phones, right? I mean, so forth and so on. So I think we'll be able to digest it, but obviously it's a risk, it's a potential, downside risk going forward. Certainly, I don't know if it keeps me up at night, but it's something I'm thinking about, more deeply as we move forward here. Okay. We covered a lot of ground. What's that?
Are you using AI at all?
I have been using it, kind of like a glorified Google,
Yeah.
Take it with a grain of salt, though, and it's not particularly useful, for, like, I thought, I could use this for helping me understand what's happening now in different economies. You can't, right? Because I think it's limited at this point, chat GPTs to 2021, right? So I go to chat GPT. How's the New York economy doing? And it says, well,
as an AI, I don't have access to.
I don't have access to the data past 2021. I can't really answer the question. And then I stupidly say, certainly hindsight stupid, quick hindsight stupid. Well, how's the economy going to do in the future? You idiot. You moron. I just told you. I can't go beyond 2021. Come on, wake up over there, human, that kind of thing. So
yeah,
I felt a little diminished, after that, but, but yeah, are you using it?
It's great for coming up with titles.
Oh, I think Marisa uses it for the statistics game, to be frank. Yeah.
How so? If she can't get the latest data in there.
Oh yeah, good point. You idiot. You moron.
It's really good at summarizing things.
You big dummy. Yeah. All right. Okay. Very good. I was thinking about badgering you about your recession call, but I'm going to wait for the right moment for that.
I felt it. Message received.
It was coming. I'm not going to do it because we're long in the tooth here, and this is Saturday morning. I actually
more script to be written, my friend.
More script to read. Yeah. Whose line is that, my friend? Yeah. Anyway, all right, we're going to call this a podcast. Unless you got anything else you want to say.
No, I think the listeners have had enough.
They've had enough. All right, dear listener, you've had enough. It was very good chatting with you. And I think next week we do we have a guest? I think we do.
I think so.
Yeah, Marisa will be back. Put us, back on put us back on the straight and narrow. Okay, with that, we're going to call it a podcast. Take care, everyone.